Ever wondered why some stocks move crazy fast while others keep a more stable growth? Well, the secret behind those wild swings might just be beta. Not the software version, but the financial ratio. A simple number that can tell you just how volatile, or stable, a stock really is. In today's video, we're diving deep into what beta is, why it matters for your investments, real-life examples, different betas in different industries, beta limitations, and how you can find this number on Yahoo Finance. So welcome to Mavic Finance, where we explain investing concepts in a simple way. By the way, this video does not contain any financial advice.
Okay, let's start with the basic definition. Beta is a measure of a stock's volatility compared to the overall market. In simpler terms, beta tells you how much a stock tends to move relative to the market, typically compared to the S&P 500. As you probably already know, the S&P 500 includes the 500 largest companies in the US, meaning it provides a snapshot of the overall health of the US stock market.
So, here's what that really means. A beta of 1 indicates the stock tends to move in line with the market.
A beta greater than 1 means the stock is more volatile. It moves faster than the market, both up and down.
A beta less than 1 means the stock is less volatile. It doesn't fluctuate as wildly as the market does. And a negative beta? That's pretty rare, but it means the stock tends to move in the opposite direction of the market. But remember, having the same beta doesn't mean a stock will move in perfect sync with the market every single day, hour, or minute. It just means that over time, its movements are generally more or less aligned with the market's overall trend. So, to really understand how beta works, let's compare some stock prices to the overall market and see how closely they move together. We'll start with a tech stock, Amazon. In this chart, the blue line represents the S&P 500 and the green line is Amazon, both shown as percentage changes over time. Amazon currently has a beta of 1.31, which means we'd expect it to be more volatile than the market, experiencing bigger gains and bigger losses. And that's exactly what we see. Between 2022 and 2023, Amazon dropped more sharply than the S&P. But later, during the recovery phase, Amazon rebounded faster, with a steeper upward trend than the broader market. Now let's look at a more stable stock, Coca-Cola, which has a beta of around 0.5. That suggests it's less volatile than the market. In this case, the S&P is shown in red, and Coca-Cola is in blue. During the strong market rally in 2020 and 2021, Coca-Cola grew, but at a much steadier pace. And in 2022, when the market dropped, Coca-Cola didn't see a significant decline. It remained relatively flat. Now, I chose these examples on purpose because they clearly reflect how beta plays out in real market behavior. But it's important to note, this isn't always the case. Market conditions, news events, or company-specific factors can cause short-term behavior that doesn't match what beta would predict. So, depending on your risk tolerance, beta can help you decide which stocks fit your strategy. Think of beta as a kind of risk thermostat. It doesn't tell you how risky a company is fundamentally, just how much its stock price tends to move. Some industries naturally have higher betas, while others tend to be more stable. Here's why. Technology. If you've ever looked at tech stocks like Tesla or Nvidia, you know they're known for big price swings. These companies are innovative, rapidly growing, and often face a lot of market speculation. Tech stocks generally have high betas, often above 1.5, meaning they move much more than the market, up or down. Consumer staples. Think of companies like Procter & Gamble or Coca-Cola. These companies produce essential products that people buy regardless of the economy. Since their earnings tend to be more stable, their betas are typically lower, often below 1. That means they don't see huge swings when the market goes up or down. Energy. While the oil and gas industry is sensitive to global events, oil prices, and geopolitical tensions, major companies like ExxonMobil and Chevron actually tend to have betas below 1. That's because they are large, diversified, and relatively stable players in the energy sector. Smaller or more specialized energy companies, however, often have higher betas due to less stability and greater exposure to market swings. Utilities. Companies in sectors like electricity, water, and gas, think Duke Energy or Southern Company, tend to have very low betas. These industries are generally more stable, with steady demand for services, so their stock movements are more muted compared to the market. Betas here can often be around 0.5 or lower. Financials. Banks and financial institutions like JP Morgan Chase or Goldman Sachs usually have betas around 1 or slightly above. The volatility can vary depending on market conditions, interest rates, and overall economic cycles, but they're usually more tied to the overall market than something like tech or energy stocks. While beta can be a useful tool, it's important to know that it has its limitations before relying on it for an investment decision. Beta is based on historical data. The number you see is derived from past stock price movements. That means beta tells you how a stock has behaved in the past, not necessarily how it will behave in the future. Market conditions change, so a stock that was relatively stable in the past might become more volatile, and vice versa. Beta doesn't account for company-specific factors. It only reflects a stock's relationship with the market, not its internal risks. A company could face unexpected challenges like management changes, regulatory issues, or legal troubles that could affect its stock price, regardless of what the market is doing. And finally, an important point to keep in mind, beta doesn't reflect returns, only volatility. A common misunderstanding is thinking a higher beta means higher returns. In reality, beta only measures volatility, not performance. A high beta stock might swing wildly, but still underperform the market. Basically, beta is a helpful indicator, but it shouldn't be your only tool when evaluating a stock. And finally, for those of you who stuck around until the end, I've got a little surprise. But I would like you to subscribe to my channel. That really helps me continue uploading investing videos. Thank you so much. So now I'm going to show you how to find a stock's beta on Yahoo Finance. First, head over to your browser and search for the stock you want to analyze, followed by Yahoo Finance. Once you're on the stock's page, you'll see its historical price chart. You can also find the beta over there. And hey, if you liked this video, you will probably like this one as well. Go check it out. Thanks for watching, and I'll see you in the next one. Bye.